Welcome to today's Explainer. Today, we're jumping straight into a pretty fascinating reality about wealth creation that we found in our sources. You know, every massive stock market fortune basically started the exact same way. We're going to look at how legends like Warren Buffett, who built literal billions from companies like Coca-Cola and American Express, did it. Spoiler alert, they didn't do it by following the hype. They did it by quietly buying what everyone else was completely ignoring. So let's really dive into this. How do these massive stock market fortunes actually start? Because here's the real secret. The thing most people miss, it is not about picking hot stocks. It's actually about finding the cold ones long before they ever heat up. To get us there, here's our roadmap for today. We're going to cover the retail investor trap, what value investing actually is, 5 mathematical signals of undervalued stocks, 4 rules for buying correctly, and finally, the value investor mindset. Let's get into it. All right, part 1, the retail investor trap. Think back for a second to the year 2000 with the dot-com bubble, then the 2008 housing crash, and the 2021 crypto collapse. The names change, right? But the pattern literally never does. Every single cycle, retail investors get completely glued to the financial news, they blindly follow the hype, and they buy into obvious traps right at the absolute peak. Just look at the stark contrast here. By the time a stock is trending on the news and everybody at the office is talking about it, well, the smart money is already quietly selling their shares. And who are they selling to? The excited retail investor who is buying at the peak and is inevitably about to be left holding the bag. Which brings us to part 2. What exactly is value investing? The fix here is counterintuitive, but surprisingly simple. You have got to stop buying what everyone is talking about and start finding what nobody is talking about yet. I know, it sounds almost too simple, but this exact behavioral shift is the very core of value investing. It's a highly disciplined approach that has quietly created more billionaires than any other investment strategy in human history. Okay, let's get into the math. Part 3, 5 signals of undervalued stocks. Signal number 1 is your first major filter, the PE ratio. The price-to-earnings ratio tells you exactly how much you are paying out of pocket for every single dollar of a company's earnings. To give you some context on this, the S&P 500 average usually hovers right around 20 to 25. So building on that, if a PE of 25 is fairly valued, you want to start looking for stocks dropping below 15. Those are potentially cheap. But if you see a PE below 10, that is your signal to investigate right now. But hold on, a low PE alone isn't quite enough. A stock can be cheap for a reason, right? So you always have to ask, why is it so cheap? You've got to check the label for defects before you buy. That leads us right to signal 2, which is book value. Book value is just a company's assets minus its liabilities. Basically, it's what the company is actually worth if you liquidated and sold everything it owned today. This metric is great because it gives us a solid, tangible, real number to anchor our expectations on, completely separate from whatever wild future projections the market is making up. Here is the magic number, less than 1. When the stock price falls below the book value, so a ratio of less than 1, it is one of Warren Buffett's absolute favorite signals. Why? Because you're essentially buying $1 of real, physical company assets for less than $1. The market is literally valuing the company at less than its parts. That is the very definition of undervalued. Moving to signal 3, high free cash flow. Now, consider the difference here. Paper earnings? Those can easily be manipulated with clever accounting, footnotes, and asterisks. But free cash flow? That is the actual unmanipulated cash a company generates after paying all its expenses. You literally cannot fake cold, hard cash in the bank. A healthy pipeline of free cash flow paired with a low valuation is basically the holy grail for value investors. Now, signal 4 is kind of my favorite because almost nobody watches it: insider buying. This happens when executives and directors use their own personal money to quietly buy shares of their own company. Think about it. These people know the business better than anyone else on earth. If they're risking their own cash, it shows a massive belief that the price is just too low. And the best part? It's tracked publicly on SEC Form 4 filings. It's totally free intelligence, just sitting there for anyone willing to look. And finally, signal 5, a 52-week low, but, and this is key, paired with strong fundamentals. Look, seeing a stock hit a 52-week low terrifies the average crowd, but it seriously excites value investors. If the fundamentals, like earnings, cash flow, low debt, are all still remarkably strong, it just means the market has overreacted. Emotion took over, and emotion always corrects. It acts exactly like a stretched rubber band pulled down by market panic, just ready to snap right back up. So how does it all come together? You take these target metrics, a 52-week low, a PE under 15, positive free cash flow, and that SEC Form 4 insider buying, and you plug them straight into free screeners like FinViz or Yahoo Finance. Applying these filters instantly narrows down the massive universe of stocks, leaving you with a tiny handful of golden opportunities. Literally, that is how you generate your highly targeted undervalued stock shortlist. Now for part 4, 4 rules for buying correctly. Rule number 1 is super simple. Dollar cost average. Never, ever buy all at once. If you find an undervalued stock, buy 1/3 of your intended position right now. Buy another third in 30 days, and buy the final third in 60 days. By smoothing out your entry over a 60-day window, you drastically reduce the risk of bad timing. Rule 2, know your exit before you even enter the trade. You have to set the exact price that tells you your thesis is wrong, and you have to do it before you ever click buy. This ensures you have an exit plan completely free of emotion. When the moment actually arrives, there's no confusion. You just execute. Rule 3 is all about position sizing, because undervalued absolutely does not mean risk-free, right? To protect yourself from any single mistake devastating your wealth, you should never let one single stock position make up more than 5% of your total portfolio. Rule 4 requires immense patience. As the saying goes, the market can stay irrational longer than you expect, but fundamentals always win eventually. Always. Value takes time to be recognized. Remember, Warren Buffett held Coca-Cola for decades, just sitting patiently while waiting for the broader market to finally catch up to its true intrinsic value. Finally, part 5, the value investor mindset. Look, the crowd is out there buying hope, flashy headlines, and pure emotion. Value investors, we buy math, solid fundamentals, and hidden opportunities. You don't need insider information, and you certainly don't need a fancy Wall Street connection to win in this game. You really just need a free screener, those 5 signals we went over, and the discipline to buy the math that everyone else is too afraid of. Which brings us to a core philosophy I want you to take away today. Find it first, own it longest, win. That next great stock, the one that's going to double or triple, it isn't on the evening news right now. It is sitting quietly in a free screener, in the dark, waiting for an informed investor to find it. You now have the exact framework used by the wealthiest investors in history. So I'll leave you with just one question. Will you be the one who finds it first?